Bob, last year in Davos, just a year ago, you said without risk, we don't have banks. We were in a very different state. We didn't have Dodd-Frank. Financial reform was being crafted. Do global banks now stand at a less risky position?
Well, I think the whole system is safer and sounder, and I think while we don't have all of the final rules determined for capital, most of them are determined. Most of the banks know where this is going to end up, and I think finally they can focus on working with the public sector and the private sector to create jobs and to create economic growth.
So you say most of the banks know where this will end up, even though all the rules haven't been written. What do you mean? Has that compromise been reached between what the bank leaders wanted and what the regulators wanted, or is it shifting more to one side?
Well, we have Dodd-Frank, but more importantly, in my mind, we have the Basel III, and we have G20 consensus that everyone's going to implement in Basel III. We know what that does in core equity at 7%. There's still some uncertainty around will there be a buffer for certain banks and what form will that buffer take, contingent capital, bail-in bonds. But most banks know where it's going to be. And as we talked about last year, many of the global banks put themselves out in front of that. In our case, we went to 10% core equity until we knew where the rules were determined. So final certainty would help with confidence, but we're very close.
Barclays is now, correct me if I'm wrong, the third largest investment bank in the world, right?
We're one of the top 3 investment banks in the world, that's right.
So the issue of too big to fail that we heard so much about, it hasn't gone away. So I wonder if you think economies around the world are less at risk now than they were of a collapse, of a calamity.
Well, I do think the financial system is at less of a risk and banks are at less of a risk, but I think the issue is too big to fail, as you said, and that's one of the issues that isn't finally resolved.
Can it be?
Yes, I think it can. We're working very closely with the FSA, but also with the G20, with the FSB, with Governor Draghi of the Italian Central Bank, who's chairing that committee. And ultimately the question is, are we going to have large, complex banks? And the answer to that has to be yes, because we have clients and customers, corporates, that have complex needs. So the question is, in the worst case, can we fold down those institutions if something goes wrong? And that's the work that's going on around contingent capital and around resolution and recovery plans. And while it's not finalized, there's been very good work here, and I think over the next 6 to 18 months we'll come to some firm conclusions in that area with the regulators.
You sparked quite a controversy not long ago in the UK, speaking with regulators, saying, look, the period of remorse and apology on the part of banks needs to be over. You've explained that. You've said we need to look forward. But talk to me more about that. You were pressed very hard on that point. What do you mean? What do you want to be taken away from those comments?
Listen, all banks recognize what the central banks of the world did, what the regulators did in terms of providing liquidity and saving the financial system in a very difficult period at the end of 2008 when liquidity dried up. But there are also strong banks like Barclays who took no direct government money. And the important thing for us right now is to be working with the public sector and the private sector to create jobs and economic growth. I think in the UK it's a very, very good example. The Prime Minister and the Chancellor are addressing the issues around public spending, around the level of deficit, around the level of debt. And that means we're not going to see growth in job creation in the public sector. It has to come from the private sector. We saw a contraction in the fourth quarter. Some say it was weather, and I'm sure that was a part of it. But the important thing for the UK economy is that banks have confidence and are working together with the private sector to create economic growth and jobs. And that's what I meant by it's time to move on. It's time to drop the sticks and stones and move forward and do what's best for the economy.
Focusing on jobs, which are critical in the UK, now critical in the United States, is Barclays in a position to hire significantly in 2011 in both the UK and the US?
Yeah, and I think one of the themes here at Davos for the financial institutions, and we meet this afternoon, is how do we operate in the new environment of higher capital? And every one of our businesses is going to have to be fit for purpose for this new environment. But are there growth opportunities? Significant growth opportunities.
Where will the growth come from, do you believe?
Well, if we look at our business in Barclays, continued growth in the advisory business and the equity business. If we look at our wealth business, we have a 5-year organic investment plan where we're investing £400 million. Most of that is people-oriented. If we look at the opportunity in Africa, where we have operations in 10 countries, and 8 of those countries were one of the top 3 banks. Big investment opportunities in Africa and the Middle East.
And Africa's a place we don't hear enough about. It's always China, India.
Yes. And frankly, for our business in China and India, they're very interested in what we're doing in Africa.
There have been reports, Bob, that you at Barclays are seriously considering compensation reform. Can you speak to those reports? Are you overhauling the compensation system?
Yeah, I wouldn't say it's an overhaul because we've always supported the G20 principles and the FSA principles about pay for performance, not for failure. But I think you're referring to the discussion of contingent capital as part of the compensation process. And no final decisions, but we are working with the regulators to see if we can't include in our compensation contingent capital. It would be very consistent with what's best for the employees and the regulators and our owners, and we hope to complete that. But no final decisions have been made yet. And
finally, you may be based in London, but you are an American. And I'd love your opinion on the president, the administration's relationship with big business. He's put Mr. Dudley and also Mr. Immelt into his inner circle when you talk about advisors. Is the president extending an olive branch to big business right now? Is that dialogue getting better, stronger?
It's much better, Poppy. And I think the thing is, in the U.S., there has been strong stimulus, both fiscal and monetary. And now there's confidence. If you go through the State of the Union address, what were the words used most often? Jobs and business. And that's a new relationship between the administration and business. And I think that confidence is going to really get to the employment picture. And we feel that unemployment that's still in the mid 9% is going to drop to the mid 8% by the end of this year.
Really?
Yeah.
There's very few that believe that, including Fed Chairman Ben Bernanke.
Employment is a lagging indicator, and I think the final piece in the U.S. to the stimulus that's been provided is this confidence and this we're all in this together in the close working relationship between the public sector and the private sector. And I think that confidence will allow chief executives to say, yes, we can hire, and we're going to hire in the United States.
Thank you so much, Bob.
You're welcome.